Welcome to this explainer. Look, if you're focused on securing your financial future, you already know the landscape is incredibly noisy right now. Today, we're cutting through all that noise to unpack a really stark warning from our source material about the future of the middle class and exactly what it's going to take to survive the 2026 economy. We're going to dive into the mechanics of where our financial system is actually heading, why the traditional playbook is just totally failing so many people, and what you can actively do to secure your wealth in what is, let's face it, an increasingly volatile environment. Let's kick things off with this direct quote from the author. The world is changing faster than ever, and the old rules of save 10% and wait are dead. I mean, that is a heavy statement, but it perfectly captures the absolute urgency of the economic paradigm shift we're looking at today. The whole passive, patient waiting game, the one that worked flawlessly for our parents and grandparents, it's now actively working against us. We've entered a completely new economic era, and clinging to outdated advice is honestly one of the fastest ways to get left behind. So let's get right into part one, the broken rule. To figure out where we're going, we really have to understand where we've been. For generations, the absolute gold standard for everyday earners was remarkably simple. You just stash away 10% of your income, let compound interest do its quiet little thing over a few decades, and boom, eventually you retire comfortably. It was this reliable, practically undisputed blueprint for the middle class. And you know what? For a long time, it actually worked. The post-war economic boom, pretty consistent interest rates, predictable inflation, all of that meant that if you just followed this one simple metric, your purchasing power was largely protected. But the economic bedrock that allowed that 10% to safely grow, yeah, that has shifted dramatically right beneath our feet. The environment has completely changed, and it's turned what used to be a really safe bet into a major vulnerability. And that brings us to a really brutal reality check highlighted by the author. The old rule of saving 10% and waiting is actually keeping you poor. Just think about the basic mathematical mechanics at play here. When your standard savings account is yielding, say, a 1 or 2% annual return, but real-world inflation is running at 4, 5, or even higher percentages, you are mathematically losing purchasing power every single day your money just sits there. Sure, it feels safe because the actual dollar amount on your bank statement isn't dropping, right? You log in, the balance looks the same, maybe slightly higher, but the actual value of what those dollars can buy out in the real world is quietly, relentlessly evaporating. By relying on a savings account to build wealth right now, you're essentially locking your money in a burning building and just hoping the fire doesn't reach it. The traditional strategy isn't just failing to build wealth, it is actively eroding it. Which brings us to part two, the new reality. Because it's not nearly enough to just know the old rules are broken. We really have to look at the macroeconomic changes replacing them right now. Let's unpack the specific headwinds making up this new reality. First up, we're experiencing incredibly rapid economic shifts. Global supply chains are rewriting themselves, entire industries are being totally transformed by automation, and geopolitical tensions are redefining how money even moves around the world. Second, surging inflation. And look, this isn't just some abstract headline on the evening news, it's a hidden tax on literally everything you do. Think about it. If the cost of groceries, housing, and energy spikes by 20% over a few years, your salary needs to jump by that exact same amount just for you to break even. If it doesn't, your standard of living drops instantly. And finally, emerging market bubbles. Because cash is losing its value to inflation, all that money is desperately searching for high returns to try and beat it. And that creates these volatile pockets of extreme overvaluation in the market. So sitting in cash guarantees a slow loss, but recklessly chasing returns in these highly inflated bubbles, that guarantees an incredibly fast one. To see this volatility in action, take a prime example pointed out by the source, the AI bubble. The global market is absolutely hyper-fixated on artificial intelligence right now. Billions of dollars are flowing into almost any company with AI slapped on its name, pushing valuations straight into the stratosphere based on future promises rather than, actual current profits. It's a super intense and potentially very unstable market focus. And blindly jumping into this technological gold rush out of FOMO, the fear of missing out, can be just as devastating as leaving your money to stagnate in a bank. We have seen this exact movie play out before with the dot-com boom. Bubbles eventually burst. And when they finally correct to reflect actual value, the capital destruction for everyday retail investors who bought at the peak is swift and brutal. Okay, so how do we handle this? Let's move into part 3, surviving 2026. If the old rules are dead and the new reality is filled with hidden taxes and market bubbles, how does the everyday earner actually position themselves to survive?
Well, according to the analysis, to survive 2026, you need to look at the top 1%. The highest earners out there aren't just sitting on cash waiting for inflation to eat it up. They're taking calculated, active steps to outpace it. They treat their wealth as dynamic, not static. So, to navigate the coming years, the argument here is that you have to completely abandon that legacy middle-class playbook and adopt the exact same strategies being used by those at the very top of the financial pyramid.
And we can actually break this active approach down into 4 vital steps drawn from the source. Step 1. Move past traditional savings. This requires a fundamental mindset shift from just being a saver to being an investor. You absolutely have to put your capital to work. Step 2. Understand the dynamics of stock market crashes. Now, this is absolutely crucial. The 1% don't panic when the market drops. They understand that market corrections aren't disasters, they're massive wealth transfer events. By understanding how and why markets correct, you can keep some dry powder on hand, meaning liquid cash, to go in and buy high-quality assets at a steep discount when everyone else is busy panic selling. Step 3. Anticipate rapid economic shifts. This just means staying nimble. You can't just marry a single asset class and ignore the rest of the world. If the environment changes, you've got to be ready to shift your strategy, whether that means moving from tech stocks into commodities or pivoting into real estate depending on what interest rates are doing. And finally, Step 4. Actively protect wealth from inflation. This involves strategically moving capital into hard assets. We're talking things like real estate, precious metals, or even investing in businesses with such strong pricing power that they can easily pass their increased costs right on to consumers without losing any demand. Ultimately, the source argues that the absolute best defense mechanism in this new economy is understanding. Actively anticipating these shifts, rather than just passively hiding from them and crossing your fingers, is really the only reliable way to shield your money from the changing tides. Your greatest asset isn't a high-yield savings account anymore. It's financial literacy. It's having the ability to read the macroeconomic landscape, actually understand the mechanics of inflation and asset valuation, and then adapt your strategy accordingly. Knowledge and active engagement, that is exactly what separates those who build wealth during turbulent times from those who lose it. So, we leave you with this final, truly provocative thought from the text to ponder. Take a hard look at your own accounts and your own plans. Is your financial strategy built for 1996, or is it built for 2026? Based on everything we've covered today about surging inflation, market volatility, and the literal death of traditional saving, are you still clinging to the dead rules of the past? Because right now, that is the single most crucial question you can ask yourself as you navigate the economy ahead.